Thank you all for being here tonight. We really appreciate you coming out. And before we get started, I'm Tom Squares. I'm the Regional Vice President of ACM. And before I introduce our guest, I'd like to introduce Don Francesi in the back. He's our CFO, and we'll have all the answers that these guys don't have for you tonight if you have any questions. And Janice Subasic is one of our managers who's offered to be here tonight, so we appreciate her being here also. And then I want to introduce our two people up in front, and most of you I think know Mark Cantey and Frank Coleman from the bank. So I'm going to let them introduce themselves, do a quick background on yourselves, and then we can go from there. You don't want to hear me, so I'll let you go. Thanks again, and gentlemen, it's all yours.
All right. Thank you for coming. My name is Frank Coleman. I'm with Community Advantage. I'm part of the Wintrust Group banks. And Community Advantage has been around 17 years. Their sole purpose is to do reserve investment for association, but on the other side is to do capital improvement loans. So a little bit of my background, I'm a CMCA plus a RPA, which I can manage commercial properties. But my responsibility is developing relationships in Wisconsin, Illinois, and Missouri.
Good evening, folks. My name is Mark Cantey. I'm a CPA. I have a practice in Wheaton. We represent about, I almost hate to tell you, about 1,000 associations. Not everyone, but I'd like to represent everyone. But no, we represent a few associations. And we're so glad to partner really tonight with ACM. I really appreciate that they do these kinds of things. This is all about education. This is about the high-paying job that you folks have to be a board member, and the qualifications that it takes to be a board member, right? Which is to be breathing and interested. But that does not always make it that we're always qualified. Can we just be candid about that? So education is part of it, and I love clients that want to figure out how to get this thing done. All my problem clients are not in this room right now. In other words, the ones that come, that want to learn, that want to talk, that have a little bit of humility and say, okay, teach me what we don't need, what we don't know. And so that's kind of what Frank and I want to do tonight and with ACM. So again, I appreciate that they are hosting this tonight. Our format is we're small, so we can be pretty informal. We already talked tonight. We're going to be here for 6 hours. I told my wife, she goes, how long is it going to be? I said, well, it goes to 8. She goes, to 8 o'clock? I don't think we'll go that long. So if we got about 25 or so, 30 people, sometimes what I do is we speak and then we hold everything at the end. Frank and I and Tom talked, we think, and it might be a bad gamble, we could take Q&A as we go. I want to make sure I get Frank some chance to talk after I get talking. But I think we can do Q&A, and if it looks like I'm getting, Frank, how much time do you want?
2 hours.
Okay, so if we get to if I get to 7, I'm going to shut it down, and then we'll let Frank talk, and we'll get to 7:30. Would that be all right? Well, we're here till 8, but we're going to honor your time. But you'll be no later than 8. That I assure you. I want to honor your folks' time. Did you guys get? There's 2 handouts. Are you working off a handout?
Yeah, you should have one of my handout. So.
I have a handout. It says budgeting and the importance of reserve accounts. Do you have that?
Yes.
Because if not, Tom's got them in the back and he's happy to give you one. But that's what I'm working off of. And question for you tonight, when's the best time to do budgeting for your association?
No.
All right, I heard. Now, Sue's been to a few of my seminars, so she knows some of the answers. So it's like my wife, she'll come to some of my stuff and she'll raise her hand. I says, Jody, you cannot raise your hand on my stuff. You know the answers. But all the time, don't you agree with that? Really, when you're talking about budgeting, and if you think about budgeting, it's one of the most important functions that you have. You are establishing a legal document. Did you know that? The budget becomes a legal document once it becomes approved. How important is that you start from a 0 sheet of paper and create a legal document, which therefore enables you to foreclose on somebody's property if they don't pay it?
Right.
It's a pretty substantial, important document. You guys get that. You get the heaviness and the weightiness of it, which is why you're here. But I always want to talk about, well, when is a good time to do budgeting? And this is the season to do budgeting. But the time to be thinking about budgeting is all the time. I have so many associations, let me say it this way, I got property managers that will call me, say, I'm putting the budget together and I got a board meeting tonight. Now, not ACM managers, but some other managers. will call me sometimes and say, I'm going to the board meeting tonight. What's your quote for the year? Well, I might or might not be in the office, and they're assembling data as they go at the very last minute. I'm urging you folks not to do that. The budget is yours, it's not management's, but management's job is to help you do it. But I want you guys to be thinking about the budget all year long. So if Cantey finishes the audit, the very next thing you should do is call Mark, or call your auditor and say, give me a quote for next year, so I can start dropping it in. Even as you get other bids, start dropping those in. But you want to start building this thing as it goes. So when you get to this time of year, it's less painful. Because it's a painful process, assembling all this data. So good, so far you're 100%. But what I like to do with these kinds of conversations is let's just first talk about why the need for a discussion on budgeting and reserve accounts. And I want to build a thesis. I want to build an argument why we have to spend some energy talking about this in the very first place. And I've got here on my bullets, well, first of all, your association's a not-for-profit entity. There's some presumptions there. It's implicit. It's implicit that you're not to make any money. So you're to budget to zero. Now, I have 1,000 accounts, and I've been doing this for 25 years. That's 25,000 budgets. None of them come to zero ever exactly. So we're charged to budget this well, and we're charged to get it to zero, but it never comes to zero. And yes, you are incorporated under the Illinois Not-for-Profit Act, but you're also not to be a not-for-loss business as well.
Yeah.
So you have a stewardship to get this thing as close as you can, as well as you can, to zero. As a matter of fact, on the way over here, one of my VPs, Karen, we had a meeting with somebody this afternoon, and the board turned over, and they're all upset that the thing got turned over by the developer, and they're in a deficit situation. Which meant in prior situations, the budgets weren't sufficient to pay the bills. And it just cascaded to a point when it finally turned over to the homeowners, they've been left in a deficit situation.
Nice.
And that's a budgeting issue. Because if last year was a loss, then we got to catch up this year, right? So one of the issues is why we need to talk about is you are not for profit. And so our job is to develop a budget as close as we can to perfection, knowing that it never comes that way, right? How about this next one? You hear this all the time. If you've been to any seminars, particularly with a lawyer, it's the fiduciary word. The board has a fiduciary role. And when you think of the word fiduciary, talk to me. What do you think of when you think of the word, or when I say to you, you're a fiduciary?
Responsible.
You are responsible.
Legally responsible.
Legally responsible. Both those are true.
You're a custodian of the funds of the association.
You are the custodian of the funds. So the implications of you are responsible, you are legally responsible, you are the custodian, legally custodian, continue on with the implications.
Moral.
So you're the custodian. So guess what? I'm on my own board. I'm the custodian. I'm going to take all our reserve money and I'm going to go to the boats tomorrow.
Well, that would be wrong.
That would be wrong. Because it would violate fiduciary responsibility. And why would it violate the fiduciary responsibility?
You're accountable.
You are accountable, but what if I win? I'll account for that. I'm an accountant. Yes, sir.
Fiduciary should act in the best interest of.
We're getting somewhere.
There you go.
Yes, sir. So here's a fiduciary. And everything you folks are saying is so right. But I want you to have this mental picture of a fiduciary. You are a steward. You are a custodian. You are responsible. You are legally responsible. But you are a steward. A steward is somebody that manages somebody else's money because they got to give it back. It's not your money. So because it's not my money, I can't go to the boats. I don't go to the boats, but if I did go to the boats, it'd be on my own money. I can't take your money if I'm the board, Frank and I are the board, and you are the constituents. I can't take our money and go to the boat. Even though you can only get 0.00001% on a CD today, there's no stewardship with that decision, agreed? We're managing other people's money. And the law in Illinois holds us as a fiduciary at the highest standard possible. It's very high standard. What a reasonable, prudent business person would do. That's how you're supposed to manage the finances. So whether you like it or not, you are a fiduciary. And some of us say, well, I didn't sign up for that job. And I get that. I get that. Here's the best thing you can do. Rely heavily on good advice. It's not, you don't get paid a lot to do what you do, so listen to your lawyer, listen to your accountant, listen to your manager. Rely on them. Nothing's more difficult, I think, for you than go rogue on advice that you got from counsel. then you're out there on your own. You guys tracking with me? I've had clients that are out in the stock market. They won't listen to me. They're on their own. So as a fiduciary, surround yourself with people that are doing this, and if you don't like their advice, it's always good to get second or third opinions if that makes sense, right? You don't like my advice, get another accountant's opinion. I think that's fine. Before I got in the car over here, I was talking to one of my people about they got a big settlement from IDOT, Illinois Department of Transportation. They took some of their property, and it's going to be taxable, but I'm not exactly sure how it's going to shake out. I says, tell them to go talk to their attorney and you can get a tax attorney's opinion. I'm okay with that. I'm a generalist. I'm not an expert in everything. You want to be with people that know what they know and what they don't know, and then refer you to the parts that they don't know. So get good counsel in that regard. So you're a fiduciary. How about this bullet point? Cash flow is often a problem. Why are we talking about budgeting? Cash flow is a problem. Is that fair to say? Many of you that have been working with your association's been around for a while, could be the victim of a disease that I call second and third generation board syndrome. In other words, you've inherited what others didn't do well 15 years ago. Now, my wife says I'm always glass half empty. Maybe it's glass half full. Maybe you inherited a fantastic situation. But I'm kind of in the business of I see mostly problems. So not everybody's always doing well. But whatever they didn't do 10 or 15 years ago, you've inherited that. Would you subscribe to that? But now since you're here tonight, you're on the board. And by the way, I'm assuming, is everybody a board member? Right? So we're all board members. So we don't want you to be me talking about you 10 or 15 years from now. So this budgeting is everything. And you'll have to make some hard decisions, because maybe you're new on the board and last year the assessment was $100 when it really should be $125. And now you got decisions, you got dialogue, and you're not popular with your neighbor. You're not popular, right? They're knocking on your door. You know, we always used to be $100, and now you get on the board and it's $125. Needs to be what it is, right? How about this? All right, so boards often inherit what predecessors didn't do in the past. I talked about that. Understanding the importance of why a budget is created. Let's just nail this really, really clear. Why do we prepare a budget?
So we know where to spend the money.
That's true. But I'm looking for another answer.
How much money we have?
That's true. Looking for another answer. For the assessments. The whole legal reason of why you prepare a budget is to help you manage your money, to help to know where it's coming from and where it's going, but it's all about creating an assessment stream. That's it. That's the legal reason of why you have been put in business, is to create an assessment stream. Well, what's the number? Well, the number's based on the budget. That's the reason for the budget. But it is all these other items too. It helps you manage well, right? Okay. Reasonable reserves are to be provided in the budget. Since 1990, Illinois says you shall provide for reasonable reserves. So then the $64,000 question. It's reasonable. So the state says, well, we won't leave you hanging. We won't tell you exactly what's reasonable, but we'll tell you how to go about it. Or a better way to say, things to be thinking about. And one of them is, there's a 5-point test. My memory's going to be stressed here. But one of them is the ability to go get a loan. If you're able to get a loan from Frank, then maybe you don't need so much. That's fair, right? The other is the impact. If the assessments are 100 and we make them 300, nobody's going to be able to sell a unit. Nobody's going to want to buy in our place, because the condos that look just like ours across the street are at $200 a month. So the law acknowledges the ability to not only get a financing, but the ability or the inability or the impact of market value on the units, right? But then they also say, well, what about the return on investments? Evidently back in 1990, and my memory doesn't go back that far, evidently return on investments was so high that was a factor to think through. Now, nobody gets anything more than 1% at most. But I think back then, some of us remember, we might have got 6, 7, 8, 9%. Obviously, you need less if you got a higher rate of return. And then one of the other factors is a reserve study. If you've got a reserve study, it helps determine what your reserve should be. How many people here have a reserve study? Let's go. Half, maybe less than half. be my desire that all you guys would eventually move that way. Now, if you've got a small association, you're 4 units, you don't need one. If you're 16 units, maybe you don't need one. I have a corporate condo, I'm on the board. I don't have one, even though I preach it all the time. You need a study, you need a study. There's ways to get around it. But a study, to me, is one of the best ways to figure out what really is reasonable. But you factor all of these things, because even if the study says you need $500 a month and your assessments have only been 100 for the last 10 years, you're not going to be able to go from 100 to 500. So you'll have to factor in these other things. Maybe we'll special assess in 5 years. Maybe we'll have to do a loan in 5 years. Those kinds of things. Right? But reasonable reserves you have to factor in. What I don't want you to do is just drop a number in your budget without thinking this through a bit. And then why are we talking about budgets and reserves? Because reserves are frequently underfunded. Boards should communicate the budget to the homeowners clearly. Let me tell you a story. We do a lot of audits for associations, and one of the things we ask for is the budget. And as part of the budget, we sometimes we will see the letter stapled to the budget from the management company and or the board saying, Mr. and Mrs. Homeowner, here's your 2017 budget, your 2016 budget. And by the way, life is great. We really worked hard to develop this budget, and assessments have not increased, and things are great, and you should be proud of how good a job we've done, and rest assured your assessments are going to stay the same. Well, I see that letter in my file stapled to the budget, and I'm their auditor, and I know that life isn't good. But yet I know that they've told all their prospective homeowners and buyers that life is good. I'm suggesting to you, be careful with that letter. I would suggest to you just staple to the budget from the board of directors, here's your budget, love and kisses. That's it. You don't need any narrative about how great of a job you did to put it all together. You guys with me on that?
Yeah.
Just be careful that it's in sync with that you're telling one story, right? See, you guys are here, so you get this, but the people that can be the problem are the ones that aren't here, the ones that are your neighbors. And they only come to the board meetings because you've done something.
Complain about the new assessment.
They're complaining about the assessments. You'll always get a full board meeting when you increase assessments, right? All right. Done properly, the budget becomes an excellent management tool. It becomes one of your best tools, right? Okay, so here we go. You guys are not asking any questions. So far, so good?
Yeah.
Any questions so far before I move to the next part?
No.
You guys are looking at me. All right, we're moving fast. All right. So have I created enough of a thesis of why we even should be talking about it?
Right.
Good. All right. So, budgeting best practices. Let's get to some practical stuff. Let's move from the esoterical, the theoretical, the philosophical to the practical. And know what your legal documents call for. You guys should be very, very, very intimate with your declaration bylaws. Have you guys read them?
Yes. Yeah.
Several times.
Good. And sometimes the more you read them, the more confusing they are. That's okay. Highlight those items, flag those items, and get some clarification of those items. We read them all day long, management reads them all day long, and they're all different. Your decks aren't the same as my decks. They can be, but they're not commonly the same, right? So make sure you guys are intimate with what the decks say, particularly with what we're talking about tonight is the budgeting section. It's usually section 6, not always, but we see time and time again, there's this one master template that somebody created years ago, and they just keep rubber stamping this and changing it. And it's usually section 6 in your declaration. It talks about the budgeting side. But don't hold me to that. Yours could be a different section. But your declaration will talk about actually the mechanics of how to create the budget. Some of you will have a section in your decks that say, if you had a profit last year, you got to factor that in. If you had a loss last year, you got to factor that in. Now let's just talk amongst ourselves. Who does that? I'm seeing some heads shaking no. I'm going to submit to you most of my associations, when they create a budget, they are benign in their thinking. They're not thinking at all about the current year or how last year went. Is that fair?
No.
It's not fair. So you do think about it.
Oh, yeah.
Very good.
Yeah.
I'm suggesting to you, some of your declarations will require you to think about it. You guys all heard about the Palm case. You're ad nauseum, right? You're tired of it? What Palm case, right? Palm was, most people are they're aggravated as it relates to the meeting issue. Is that fair? No more, you can't send 5 emails together, get a lot done on the email, ratify it at a board meeting, have a board meeting be an hour instead of 6 hours. Everybody gets that. By the way, there's some loosening up of that. You guys are familiar with that as well, right? That's just some new law that is kind of loosening it up. Talk to your manager, talk to your lawyer about that, but they've loosened up a little bit about that. But Palm had another factor to the whole case, and it was the financial side. I thought they did a fantastic job, the board. If they would have asked me how well they were doing back then, I would have said, I think you do really well. They were in violation of breaching their fiduciary duty with what they did. And I would have given them an A. Here's what they did. If they had a profit for the year, and I use the word profit just so we can all understand, they had an excess of revenues over expenses in their budget. They would take that excess and put it in reserves. Isn't that a nice thing to do?
Yes. Not if your declarations say that you have to give it back to the resident.
And that's precisely what their declaration said. Now, I've been doing this a long, long time. Let's just have public confession. Nobody prior to Palm, when I say nobody, prior to Palm was writing checks back to the homeowners. You'll be hard-pressed to find a lawyer, an accountant, a manager that'll tell you, oh yeah, that's so common, we always did that. Most of us, if we ever had excess money in the operations, you put in the reserves. Think it through for a minute. What homeowner wants a check back?
All of them.
All of them.
Janet says all of them. All right, very good. You're stepping into my trap. What homeowner wants a call the next month and says, oh, we're under now, we don't want more?
Exactly.
They don't want that.
No, no.
So, let me set you up really nice and easy. What homeowner wants a nice, even keel?
All of them.
All of them. So, the way we managed forever, and by the way, this industry is not that old. You guys, it's one of the youngest industries in the world, if you think about it. Condos are only 40, 50 years old. That's a pretty young industry. It might be even younger than computers. We're not that old. So we're morphing, we're growing, we're trying to figure this thing out. When they were first created, here's my theory. When they were first created condos, somebody probably says, you're going to do what? I'm going to own my apartment? Why would I do that? Who's going to control it? A bunch of your neighbors are going to control it. I'm going to give all my money to them, let it control it? Don't worry. We're going to put something in there that says if they have extra money that they don't need, they'll make sure they give it back to you. So they're only going to keep what they need. In my mind, that's how I think some of these decks were created. I don't know that to be factual. That's how I reconcile this. But here's what 2800 was doing, is that they had excess money they put in reserves because they contended their reserves were underfunded. And they're saying, why would we kick it back to you guys? And then when we need more money in the reserves, we'll special assess you. Our people don't want that. But the judge was kind of with his hands tied, says, well, I read the decks to say this, and you didn't do this, and you knew that it said that, and you didn't do that. I think you guys, you didn't do your job. And they had a plaintiff who was a lawyer, and he read it exactly the way it was. And they got in trouble for that. Now I'm submitting to you that about half of your decks, if you have older decks, the older decks have that language. Not always, but in my portfolio, after 2800 came out, we shut our office down and we looked at everything in our files. It was a killer. I hated it. It was right during tax season. I got an email from a lawyer friend of mine telling me about it. As it turned out, I knew the lawyer that represented 2800. I called him and we went through it. And we shut our office down, we looked at all our decks and bylaws of our clients, and the ones that had it tend to be our older associations. Newer decks don't seem to have it for whatever reason. Newer, when I mean newer, 10 years old.
So you're talking about the mandate to return the excess
Yes, sir.
money? Okay.
Yes. Now, so You may have that in your decks. And guys, keep in mind, this is all about budgeting. Because if you've got to give some money back, then you have to factor in your 2017, you got to factor that into your budget. That's cash out the door, it's going back. I think it's loaded with all kinds of inherent issues. I think there's some get out of jail cards, but you can't ignore it. You have to work with your lawyer and your accountant to do it. Let me give you a real life example. Let's say in 2016, you have budgeted to do some siding, or not siding, but some repairs and maintenance. But we've had a rainy fall. Let's say 2016, from here on out, it just rains like crazy. We may not get to the project. Well, that doesn't trouble you, because you say, well, you know, we budgeted for it, we budgeted $100 grand to do the work. We'll just do it in the spring of 2017. Well, according to Gary Palm, and according to your decks and bylaws, there's no leeway for that. You'd have to give that money back. So I'm not saying you have to, but I'm saying you got to at least acknowledge that there's some tension there. We'll have to figure that one out. But I just want to give you a real life example of how this could cause some issues. Right? Now, let me flip it around. We talk about giving money back if you have a profit. There's always the other side of the coin. Always. The next sentence in your language might say this: if there's a deficit, you have to charge the homeowners. Now, remember when I said how many of us have given money back in the past? No one. How many people have just charged because there's been a deficit in the 2015 budget? No one. So now I move into your community, and I know. And so in the fall of 2016, I just moved in last month. You've had 3 years of deficits. You have that language. You never went back and charged people. So now this fall, you decided to do a special assessment to replenish reserves, and I'm in the know. And I'm not going to be happy. You didn't do your job for the last 3 years, and now I'm a brand new kid on the block, and you want me to pay for it. I'm going to create some stink. Are you guys tracking with me? I'm trying to just put a little fear of God into you, that make sure you know what your decks say. Don't ignore it, and factor it in wisely. There's ways to work through this. I really believe that. By the way, I worked with about 10 different lawyers in this whole Palm thing. I got about 9 different answers. But I will submit to you, of the 9 different answers, I like most of them. There's just different ways to solve it. And I'm okay with that. Very few of them solve it the way I'd solve it. But I'm okay with the way they want to do some things. And so we're not dead in the water on this. I just don't want you to ignore it like our whole industry did. There's ways to solve this. You were going to ask a question?
I was under the impression that a special assessment had to be for a specific reason and not to fund the reserves.
I think that's generally true, but it doesn't have to be. Now that I think about it, I do have some clients that have special assessed to replenish the reserve accounts.
How do you, well, I suppose we'd have to find out how to get around that.
I think
For the accounts.
I think you can. I think you can special assess to replenish reserves. I have seen it.
Okay.
That's a lawyer question. I call the balls and strikes as they're thrown, but he or she decides whether we should do it this way or that way. Anytime you have a declaration conversation, that's a lawyer conversation. Believe it or not, your managers have a license, and one of the license requirements is they cannot practice law. So don't ask your manager to interpret the decks on gray areas. It's not to their benefit, it really isn't to yours. They will have an opinion, but if it's really gray, I'm going to submit to you, spend the money and get an opinion. There's certain mountains to make sure you keep solid. And opinions of interpretations of the decks are clearly one of them. That's where you spend your money. Right? Your manager's not supposed to know all that stuff, or your accountant, but your lawyer, that's his or her job. Does that make sense?
Yes.
So, the coin will cut both ways if it has that. If you have that, and I'm going to say with all the folks we have here, I'm going to bet you 5 or 8 of you have that language in your decks. You got to be cognizant of it. So what you have to do is you're doing your budgeting now for 2017. You got to kind of look at where's 16 going. How's 16 going? Are we flush? Are we flush for a reason? Is it just because we haven't spent the money? Well, maybe we we show the carryover, the projected carryover to next year, because we haven't spent it, and you add one more budget line item to next year for that project that we didn't do. See, there's ways to get this done. Are you guys tracking with me?
Yeah, but that's next year's budget.
That's next year's budget. But if your declarations say you got to carry over the excess, carry over the excess. But add a line item for the item that you now didn't do last year, you're going to do this year.
Okay.
Just say 2015 project, not done, to be done in 2016. I like transparency. You can explain your homeowners. In other words, work with me, work with management, work with your lawyer. We can solve this. What we've done in the past is we just have ignored it. It's not insurmountable, but I just want to get your attention. I think I've done a good enough job to at least say, hey, the days of ignoring that section in your bylaws is over, but they're solvable, and they're not that sophisticated to solve. That would be one way. There's other ways.
That
Yes, sir.
topic is why I'm here tonight.
Okay.
Because we're guilty.
Well,
Okay?
so
Three years of not doing it right.
Yes,
And
ma'am.
now the current board, are we going to jail?
no, you know what?
Good
You know what? Even in my, I got to tell you, every year I'm in business, I do things differently every year. Every year I get a little smarter. I'll ask, why? Well, that's how we did last year. I go, which by the way is never something you say in my office. That's how we always did it. We just fix it. Okay, so if you finally realize after 3 years, then we're going to have to develop a plan. Now, so you may not be able to recapture 3 years all in 1 year, so you'll develop a plan. We become aware of it, we've talked to council, we've talked to the accountants and management. Over the next 3 years, we're going to recapture this. At some point, folks, we got to be, I always end every seminar I talk about is you got to run this like a business, because guess what it is? It's a business. If I need more money in my practice, I'll just triple my fees. How about that? Can I do that?
No.
I could, but what would be the effect? Customers. So using, just picking on Sue for a minute, if she realizes and just figured out with her and her board that, or even inherited it, let's say, that over the last 3 years we're in trouble, she may not be able to recapture it all in the first year. She has to run this as a business, but develop a plan and document the plan and have your lawyer help you with the plan and say, you know what, we're going to correct the sins of the past over the next 36 months. It's better. Sometimes that's the best we can do, right? The piece that I always want to reinforce to you is you're in the boat with your folks. And you always need to remind them of that.
Yeah.
So when you're making hard decisions that impact them, who else does it impact? So you need to remind them of that.
I'm sorry.
That's okay. Janet.
All right, we did our proposed budget the first of this month. In November, we will approve it.
Yes.
But we did it based on what we spent and what we think we're going to spend at the end of the year.
Yes.
So you're talking about that zero budget.
Yes.
How do we know how much to put into that fund for 2017? I mean, we can fix our budget in November.
And see there lies. See.
How do you come to that? You don't know what you're going to spend. You don't know how much to hold back.
The whole 2800 case was a no-win situation for the board. You don't know what to do until the year's over.
Yeah. And then your budget's already.
As a matter of fact, you don't really know your year end until February. But you had to do a budget back in September.
Yeah, that's
I
right.
get that. So the best you can do, in my opinion, is the minute you do know, you make adjustments. So you come in and ACM finishes the financials and it's mid-February, let's say, or late January for December. Usually give them a little extra time at the end of the year to close out things. Just so if they're normally doing the 20th of the month or the 15th, give them a couple more weeks so that they can get everything done. But maybe the 1st of February you find out that you do have an excess or you do have a deficit. At that point, at your next meetings, you're starting to work with your accountant, your lawyer, and management. And okay, what do we do with 2016? Budget's already been passed. What do we do? And some of the answers can be we adjust the assessment stream. Another is you leave the assessment stream alone, but you amend the budget to show the profit, but now you increase the reserve contribution for the exact same amount
So you can
because you're
amend the
underfunded
budget.
reserves, so the assessment stream stays the same.
You can amend the budget then?
Yes, ma'am.
Okay.
You can amend the budget every day of the year, but you have to do it legally, which means formal notice, You have to go through the same procedures.
Okay.
Yes, you can do it, yeah.
Okay.
Anytime you realize you have a bad budget, you can fix it, but you have to go through the procedures. I have some associations and boards, they just want to just change it, and I say you can't do that. You got to tell your constituents everything you're doing, formal notice and all these
Yeah.
things. Even if you're going to take a line from here to here, I contend you need to let them know.
Mark?
Yes, sir.
Where's the best place to get the background and history on the Palm case?
Do you really want it?
I'd like to do more research on it, be more familiar.
Probably your lawyer,
Yeah.
because they'll have the case. You got to understand, though, with the financial side of it, it's actually not in the appellate side, it's in the case underneath it. And that one's a little harder to find. The appellate case you can probably find on the internet, but the case underneath it you may not find on the
The
internet.
district case, the original case?
Yes, sir. Yeah.
I have one more question,
Yes,
and this
yes.
may be something you're going to still cover.
Okay.
All right, we have line items for our budget for 2016.
Yes.
We've overspent on one line item, but we need to borrow from another. Do we have to stick with those line items, or since it's all operating budget, can we borrow from other line items?
So you have 10,000 in landscaping and you've only spent 8,000, but you've overspent in another one.
Yeah,
So you want to borrow 2,000 on a landscape because there's 2,000 there
yeah,
to pay for the other. I
Yeah.
tend not to like that.
okay,
I tend not to, I tend not to go for that.
okay.
Yes, it is all one big pot,
Mhm.
but I would tend to tell you just, here's how I would do it. If I was on the board with you, I'd say, Janet, here's what we're going to do. We're not going to go with specificity and document in the minutes that we borrowed from landscaping 2,000 to pay snow plow because we're over there, but we're under there.
Yeah.
We're just going to spend the $2,000, and we're going to end up at the end of the year. We're going to be over budget here, but we're going to be under here. It's all going to zero out,
Yeah.
and life is fine. And we're moving on. But I don't want to get so granular telling my homeowners that I've got 100 little buckets of dollars and I'm taking dollars out of here and there. I don't manage that way. I manage this way to create an assessment stream and I'm beholden to it, but I'm going to manage the whole $100.
Okay.
So if I feel I got to spend more than the budget, I'll do that, but I'll do that because I know I'm under on a couple others. So when we do the audit, you'll show under, over, zero, or whatever the number is.
Okay.
But we don't need to have the conversation documented that we're borrowing from Peter to pay Paul.
Okay.
If that makes sense. Are you guys with me? Yes,
So
ma'am?
it's
But then
just-
you use that information when you develop the next year's budget.
Yes, you do. You know, if it was me, I'd have an Excel spreadsheet and I would just start building the years. Budget, actual, budget, actual, budget, actual. You know, what you can measure, you can manage. You need good data. You need as much data as you can get. You need to start seeing trends. You'll see, if you're an association that's been around a while, you'll see certain trends. You'll see snow, of course, depending on what's going on. You'll see gas that fluctuates. You'll see insurance fluctuates depending on the markets. I think we're in a soft market now with insurance, I think. But that's not always the case,
Oh, no.
right?
Oh, no.
So you need all this data to develop a good budget. You guys are asking great questions. So, know what your legal documents call for in calculating the budget are prior year and current year overages to be considered. Exercise care in communicating budgeting news to homeowners. I've talked about that already. Here we go. Separate the budget between operating fund and reserve funds. Your decks will call for that. So make sure you separate that. All right? Here we go. Operating fund budgeting considerations. When you finally develop your budget, tell management how you want to lay out the expenditure. It doesn't seem to me to make any sense that you'd have snowplow, let's say it's $12,000 for this year. Do we want $1,000 every month in the budget? No. We're in August now. You don't want in your August financial $1,000 of snow budget. So take your snow, I'm using that as an example. If it's $12,000, put $3,000 in, or whatever you want to do, but 3 in January, 3 in February, 3 in March. What else do I need? Another 3 in December, let's say. So put them in the months where your contract numbers are going to fall, so that as you get your monthly financials, you've got your budget numbers as close as you can to the reality of it is. Many times, management will just divide it by 12 unless you tell them otherwise. They don't know sometimes what you want to do with that. So work with them on that. I think, Don, you can split that out, right, in the months you want?
We do that.
You do that. So Don, by the way, Don he's about as good as they get. We work with a lot of management companies, and just to pick on Don for a minute, he's pretty granular, and that's a compliment. In other words, he gets in the minutia. I work with a lot of management companies, they don't get in the minutia. And so Don does. He'll call my office, and he's calling about $22. That's good. That tells me that as a CFO controller, they care about that stuff. So Don's splitting it out. That's good. See, as your auditor, I wouldn't always know that because I'm picking up the pieces at the end. I just get the full year-end financial. I'm not looking at your budget spread, but I just want to make sure you guys are doing the budget spread that way. Very good. Okay, of course, give consideration to prior year surplus and deficit if that's the case. Make sure that you're budgeting for uncollectible accounts. The market's starting to get better, and from 08 to about 012, it was a disaster. And 10 years ago, 15 years ago, nobody was budgeting for bad debts. There was no such thing. And then all of a sudden, after the 08 crash, there were foreclosures. None of us had seen any of that. And so I was telling my clients, make sure you budget for that. Would you know I got a lot of pushback on that? A lot of pushback. For crazy reasons, in my opinion. That makes us look bad that we're not collecting our money. But you're not collecting your money. That's the reality of it. You mean to tell me that we got to now charge $105 to collect $100 to pay the $100 in bills? Yes. You mean to tell me that the rest of us, the 99, are paying for the one? The answer to that is yes. But if you have some accounts that are slow to pay, be abundantly clear what I'm saying. I want you to hear this. I'm not saying that you put in the budget that you're just going to write these folks off. I'm saying that the budget is a year estimate of cash flow. And if you know somebody's really in the hole and you're not going to get the money in 6 months to a year, let's just call a spade a spade. You go after them, vigorously, but you may not get it for 6 months to a year. But yet you need $100 to pay all the bills. So you may have to put a line item for $5 so that you get $105 that really ends up to being $100. You guys tracking with me? And I get pushback on that. All right, here we go. I'm seeing more and more and more of this. My last item on page 1. We're moving along. Income tax. I'm seeing clients get Comcast money. Anybody get Comcast money? Comcast will come into your community and they will cut you a deal to get an exclusive agreement to market all your people. And they will give you some money. And I have some associations, they'll get $50,000, $75,000 for big communities. Why would you not do it? And almost everyone does do it. But the IRS wants a cut of it. So $75,000 ain't all your money. So we got a budget. If you know you're going to cut this deal next year, let's budget something less. You know what I mean? If you're going to get 75, let's budget 25 or 30 to Uncle Sam. It's not all yours. Yes, ma'am.
I'm not really sure where this question falls in, and maybe it's like at the end or something. So if you've done a special assessment and you've collected that money for a specific project.
Yes. So you special assess for the roof.
Okay.
Yes.
But you don't do the roof.
Okay.
How long can you just keep that money sitting there until one day you decide to do the roof?
Everybody hear the question?
Yeah.
Well, I think the question begs some other questions.
Yeah.
So you assessed me some money and you now decide you're not going to do the roof. There should be a really good reason for that. If it was my association, if you were my client, I'd say, I'd like you to take that money, since you've told everybody and you special assessed those people, I'd like you to take some of that money and park it. Park it. You with me? Segregate it. So if you special assessed $100,000 for the roofs, and now for whatever reason you've decided not to, I think I'd say until we can figure out what we're doing, let's segregate that $100,000 and not spend it.
Okay, so it has been.
Good.
So how long can you just leave it parked?
I don't know. You got to do the roofs eventually. See, we're running this as like a business, so there must have been a good business reason why you did it. I can't think of one right now, but maybe there is. But if there is, presuming that there is, then we will communicate clearly why we made such a good decision, and that we're going to set this money aside for when we do need to do the roofs.
Can you
use it for a
Yeah.
different
So-
project?
I would submit to you no,
Well,
but that's a lawyer question, but if I'm playing lawyer and I don't want to play lawyer, but as just a nerdy old accountant, I would say no. You special assess for a purpose, I'm gonna look for the accounting for that specific purpose, and I bet if I had a lawyer up here tonight, he or she would say the same thing. So if that's a real life question, I'd have you talk to management and your lawyer about that, about what do we do? I'm intrigued why you special assessed and chose not to do it. I'm intrigued by that. There's always reasons. I've seen everything, and management's seen everything, and you've already now seen everything. So there's a reason I'm not, but I'd be curious to know why.
Because it's not like it's a frivolous project, it's a roof.
You special assessed. Somebody decided to wake up one morning and say, we need to go back and ding everybody for an extra assessment. Special assessments will always get people's attention. And so you special assessed, and yet I don't see a new roof going on. We ought to be talking about that. There's a reason, I bet. I don't want to cast aspersions, but we don't know enough. You've asked me publicly to help solve something that I don't have all the data. And the data could be excellent. And as soon as we got all the data, we'd all say, well, that's why. Well, yeah.
I'm new on the board, and so I'm
Yeah.
trying to understand,
Yeah.
and so it's a
Yeah.
question that I just
So the
keep
question,
asking, and I
so
don't get an answer.
Janine, the question simply is why did we special assess and why are we not doing it? Those two questions you need to get the answers to. I got one young man in my office, he's always down to the third, he's always wanting me to answer the third question. And I says, so-and-so, we gotta get these first two answered. As soon as we get the first two answered, this hypothetical one you already are creating, we'll get there. But I gotta get those two answered. He drives me crazy. He's young, he's good, he drives me crazy. He's got so much energy. He's always at the third question, but in an example like this. Well, what if they say this and then they do? Let's just wait to see what their reasons are. It could be very legitimate. I don't know. Okay, I want to continue and nail this income tax. Comcast is one item, AT&T money, but easement money, sometimes a utility company will come in and say, we have got to take this strip right here through the room for to lay utility easement. We're going to pay you some money each year. That's going to be taxable. IDOT, the Illinois Department of Transportation, sometimes takes some of your frontage property, and they'll steal your property, but they'll pay you some sum that you may or may not have liked.
Right.
And that might be taxable, that will be taxable. Now, you may spend some money to get it up to where they want it, but it may be taxable. So be aware of those items. Next page. I'm going to get to no later than 7 because Frank's got 2 hours, he said. Okay, so we talked about operating fund, reserve fund budgeting. It should start with a reserve study. So if you don't have a study, maybe this year's a good time to budget for a study. Management has some excellent companies they work with. I can give you some names, but I think they're the exact same names they work with. Get some bids and get an idea of what it might cost.
I wouldn't even know how to guess what to put into a reserve if without the study.
Love that. Yeah, you wouldn't know. Right. How would you know? Yes, ma'am.
We had a reserve study done, and I think it's now 5 or 6 years old.
Okay.
But in that time, we have replaced our driveways and
Okay.
our roofs.
Yep.
Those are the two huge
Yep.
items out
Yep.
there.
Yep.
Everything else is
Yep.
like
Yep.
minimal
You
stuff.
should get another one.
So that's right, exactly right. So Linda's advice is excellent. You've now done the lion's share of the study.
Yeah.
You've superseded the 30-year projection.
Yeah.
By the way, when you ask the question, how would I know without a study, that could be more than just rhetorical. The right answer is, I mean, even my own association as a corporate condo, we don't have a study, but what we do have is we went to a roofer and says, what will it take to replace our flat roof?
Yeah.
And he estimated about 80 grand. And we had a guy come out to look at the brickwork, the tuck pointing. We got that.
Yeah.
We've already got quotes on the concrete. For us, the big items are the roof, the tuck pointing on the brick, the parking lots are probably our biggest expense, and the concrete work, the curbs and whatnot. So we've got bids from contractors on all of that, and we laid out a spreadsheet. So we didn't do a formal reserve study, but we did get quotes. So rhetorically, how would you know? That's how you know.
Yeah. Isn't that good enough?
It's fantastic, I think. I mean, we could have got a study, but we like what we did. Now here's the key with studies, and here's the key with what we're doing. One of the problems that we have is you'll get boards that'll get a study and then they just set it and forget it. In other words, they take the study and they just put it on the shelf. It's a living document. So with our living document, we look at it every year. Okay, well, we said we're going to replace concrete in 3 years, but man, I was out looking at the curbs. The snowplow keeps banging the daylights out of them. We may have to accelerate that. We're constantly looking at our spreadsheet. Constantly look at your study. Maybe the roofs won't last 10 years. Maybe they'll only last 5. Maybe the concrete won't last 5. Maybe it's fantastic, it'll go up to 10. It goes both ways. You got to understand a reserve study is simply an estimate. It's not the gospel, it's just an estimate. And one thing, just like our budget, that you can be assured of, it's going to end up differently. So it's a tool. So the best way to harness that tool is to review it annually. And yes, if you've done some major projects, let's say it says you can do the roofs in 5, but you just did them this year. One reserve company has a website. You can take your study up on the website and start messing with it. So now you can take your roof and take it out of the equation. You don't need to be funding the same number anymore because you just finished it. So now it goes from 5 years to being due to 25 years to being due. Recalibrate that. Any way you guys mess with it, or if I messed with it, I'd probably say, let's get them back in and clean up our mess after 5 years. You know, they're going to say, what did you do to this reserve study? You know? But I don't think I'd go more than 5. Maybe ACM, you guys will get a reserve study, but a guy or gal up here as well, they might say about the same. Okay, what if there's no study? Well, if there's no study, then you're going to have to either go to the contractor issue like I did, and that can be good on smaller, manageable associations perhaps. I wrote here, what if there's a study, but the budget is not being funded per the study? So there's a study. You got a study. And it says you got to be putting $50,000 a year in. And you're putting 10 in. Comments?
You're going to be doing special assessments to people.
Maybe.
Maybe.
Remember what I said earlier, you got to run this like a business. 10 may be all the market can bear. But I want you to communicate to people that we have a study that says 50, we're only doing 10. Therefore, we might be coming towards you. You'd want to know that. So you folks should be communicating that. Those kinds of communications, that was what might be in your 2210 disclosure to potential homeowners. Make sure you're doing that with the auspices of your lawyer, making sure that you're disclosing well. Sometimes we give people more than they need, but sometimes we don't, and there's that tension there. When should the study be updated? We talked about that. Maintaining reserve funds, they should be segregated, right? Frank can talk a little bit about some of the investments that I know Barrington Bank has. They've got an excellent thing called the MaxSafe program, so that you stay under the FDIC issues. Importance of segregating operating reserves. One of the basic tenets and principles of the Palm case is the wires should not touch of operating reserves to the extent possible. Now, all that to be said, 90% of my associations do touch wires. So if they touch, clean them up. We paid out of operating reserve account. Reimburse them. Try not to do it as much as you can. If you can set up even a reserve operating account, much probably to Don's consternation, then do that. But do as much as you can to separate the accounts as much as you can. But I would say most of my associations tend to occasionally have wires that touch. What do I mean by that again? They have a common paymaster account. They pay all the bills out of this account. And if one of them happens to be a reserve item, then they'll take that reserve money, cash it out of the money market, and put it in to reimburse the account. At the end of the day, there's really no harm, no foul. But Paul was pretty weird about that. Again, I wouldn't have considered that a problem. He said it was commingling. My personal opinion, it's not, as long as you segregate and you account and you're transparent. But that was the case. My job is to tell you what the case says. So to the extent that you can keep life separate, I think that's a good thing. Right? Okay, investment policies. If you guys are starting to develop reserve monies that are adding up, you should develop an investment policy, a one-page document that says, here's what we value. Here's what we value. We value preservation of principal, or we value, at our highest value, the most money we can get on our investment. By the way, which one should it be?
Protect.
Protect. You're in the not-for-profit world. This ain't your money, you're fiduciary. Preservation of principal should be a higher value, then liquidity, then rate of return. I mean, quite honestly, guys, we could probably do okay. We could do better if we do 10-year CDs, right? But you can't get the money for 10 years unless you cash the CD and there's a penalty. So there's this tension of you can get a better rate if you go out longer, but you can't use the money. So you've got the values of preservation of principal, protecting the corpus, if you will, the liquidity and the interest rate. And so you hierarchy those. I would say, if you ask me what should you do, it'd be preservation of principal, liquidity, and then return on investment. Then you say in your investment policy, well, what investments fit that bill? CDs, maybe a T-bill or a T-note. Perhaps government-backed securities fit Fannie Mae, Ginnie Mae. Maybe. Maybe not. And then you say, and then you adopt this policy. It gets put in a resolution. It gets reviewed every year. You don't do anything without the lawyer blessing it. And there's your investment policy. And it gets reviewed every year. Somebody says, why do you do what you do in our investments? Glad you asked. We have an investment policy. Need for effective accounting, accounting and reporting systems, and I'm right on time. Segregate operations from reserve activity on the income statement. I know Don does that well. Maintain reserve investment accounts separate from operations, and maintain solid internal controls. Internal controls is simply 2 sets of eyes, checks and balances. You guys ought to just have your nose in the equation, asking a lot of questions. Right? I feel like it was a fire hose for an hour. You guys all right?
Yeah, that's very good.
All right, I'm going to turn you over to Frank, our banker, and he brought all the money tonight.
Thank you.
Thanks, Bob. First question I have is, how many people have done loans, capital improvement loans? I have a few in the audience. Here's my question. If you're going to do a capital improvement loans, what are the 2 major questions that you will ask the board?
Who's going to ask the board? The unit
The
owner?
unit owners.
Why?
Right, why? But probably the first question is, what's the effect on my assessments? Right? They want to know how much it's going to go up. The second question I go to a lot of board meetings with capital projects. The other one is, what's it going to do to my property values? Because you got people that want to go to sell their units in the next few years. The reverse of that is, what if you don't do the project? What's going to happen? Guarantee your assessments are probably going to go up because now you're going to have to collect to do all the repairs on it. All right? And if you don't do it, your property values will probably decrease because people want to sell their units and they look at the property and they said, this one looks improved, but then look at the one at across the street, it's not improved. Which one are they going to buy? So that's what we're going to discuss in capital improvement loans. I put a sheet together, hopefully everybody has one. Right? I just threw a lot of questions on here because a lot of these questions people ask, and I'm going to walk you through a little bit of them. And feel free, if you have anything, just ask me right away. The first question we always get is, what is the collateral? Realizing when we do loans, the loan is to the association, it's not to the unit owners. And our collateral, this is a cash flow loan. It is based on future assessment payments. So we take no interest in the property, and a unit owner can buy and sell their units anytime they want. You do not need the bank's permission to do so. You got to make that very clear, because a lot of unit owners feel that, oh, my units are going to be locked up, I can't sell it. That is not the case. The loan is to the association, not to the unit owners. And this is a commercial loan, not a mortgage loan. So is everybody clear on that? All right. All right. The other one, especially on board members, they ask this question. You know, is the board member going to have to do a personal guarantee? No. You are an elected official to the board. You're elected. You are serving as a position. You're a unit owner, but you are signing the loan documents as your position, not as an individual. All right? I was on a school board for 11 years. I was the treasurer. Not a lot of responsibility, $96 million budget. I was not responsible for it. I signed a lot of things, but I was not responsible. I signed as my position, all right? The next question comes up they always ask is, how long does this take, the whole process? Usually the property manager will call me up, I'll get some information up front, I'll do a loan proposal, the board will look at it. That's the time we do some negotiating back and forth. When they agree, they sign it. We ask for a lot more information because we have to do our due diligence. We have to go out to the property, make inspections, attend a couple board meetings, and then we go ahead and take all that information, write up what we call a loan credit report. We get an approval from the bank that says we're going to go ahead and do the loan, and we issue a loan commitment letter. Once we issue the loan commitment letter, you have usually about 30 days to sign the letter and return it to us that you are ready to work with the bank and we're going to provide the money. Once we get it back, now the attorneys do their work. Our attorney will look at it and looks at the decks and bylaws of the association, and your attorney will look at the decks and bylaws of the association and compare it to the loan documents. Once they agree and issue the legal opinion letter, we go ahead and have the board sign the loan documents as their position, and then we fund the loan. Usually this will take about 35, 45 days. For the attorneys, sometimes it's shorter, sometimes longer, so it depends what their time frame. So let's figure 60 days from start to finish on the process. Could be shorter, could be longer. All right. Here's the other question. I'm going to throw this out a little bit differently is, when should you call your banker when you're considering a loan? Any answers on that?
Right away?
Right away.
Yeah.
Call us. I've had associations call me 2-3 years in advance. They just call up and say, we're thinking about this project 3 years from now. We have reserved 3/4 of our dollars, and that's all we're going to probably reserve for the project, but we're going to be short 1/4 of the dollars. How much is it going to cost us? We call it gap loans. They need a gap loan to cover that shortage in their reserves, all right? So call me early, we'll run some numbers. It's very quickly to do. And you can think about it, how are you going to increase your budgets over the next few years to cover that? So call me early, all right. I'm dropping down as far as what type of projects we'll finance. Basically all the repairs of the common elements. Go back to what Mark's example was. Roof, walls, windows, parking lot, normally what we're covering. Siding, so we're going to cover all that. We have done an occasion where a unit or association will buy a unit for their maintenance person. We'll finance that too. But that's an asset of the association. All right. I'm down near the bottom of the page is what is my interest rate? And this is a very good question. Realizing when you come to me, you're painting a picture of your association. And I'm looking at some items. I'm looking at your cash flow. I'm actually going to look at your reserve studies. If you were to come to me and say you need $500,000 for this roof project, and I look at your reserve study, and you need another $500,000 for a paving project in the same time frame, I'm going to ask you, how are you going to pay for both at the same time? So I'm going to look at all those factors. A couple things I'm going to bring out. Probably what I call is the 3 major items when we do loans. What is your delinquencies? It should be 10% or under of the number of units and 10% or under of your budget. We take both of those in combination, all right? The other one is owner occupancy. You should have owner occupancy of 51% or greater, all right? And the third item I really look at is what I call debt value. Very simple to figure out. Let's say a unit is worth market value $200,000. We take 10% of that, so the debt on that unit could be $20,000. So let's just take a case. You want to know how much the association can borrow. So let's say it's 50 units in the association times 20,000. The bank would consider we could do a loan up to maybe $1 million. All right? That gives you an idea. So if you come to us and you got 50 units and you need $3 million, I don't think you're going to get it. So very simple bet. All right? Okay. But those are the 3 major items I look at. There's a number of other items you look at, but if you call me up, I can do it very quickly over the phone and qualify it. All right. And usually when we do loans, we're doing a construction line of credit. And does everybody know what a construction line of credit is? All right. It's basically during the construction period, we're going to loan you the dollars to do the construction. So we're going to qualify you, make sure you have enough dollars out there. Let's say the project's $500,000, but the bids are coming in at $450,000. All right. We're going to build a $50,000 contingency in there. Guess what? Anytime you get into a roof project, you rip off the roof, insulation could be bad, there's mold, next thing you know, you got to replace all that. All right, you don't know, so we'll try to build a contingency in there. So you're going to do the construction project, so let's say it comes in at 4 1/4. You still have a $75,000 contingency, but you could have used it if you needed to. But during that construction period, you're going to submit bills to us. And we don't use title companies, outside title companies. We're going to take the bills. 2 board members usually would sign off and tell us to pay XYZ vendor, say $10,000 for the roofer to go buy materials. Then halfway through the project, you send another bill, and then we're going to pay that bill. Let's say the construction is totally done after 4 months. Go ahead and convert it into a term loan. All right? Very simple.
What term loans are you allowing?
Normally I do term loans in 3 years, 5 years, 7, and 10 years. All right? It depends on the association, but it also goes back to the reserve study. If you have a roof project this year and you have a paving project in 5 years, I'd probably say you're probably going to have do a 5-year loan, because I don't want 2 loans on the same time. So, all right? So very important on those reserve studies. By the way, my loans run from $50,000 to $20 million. So gives you an idea of the range. All right.
Yeah.
I'm on the 2nd page. I'm going to emphasize this thing on special assessments. Actually, it's probably on the 2nd page on special assessments. And this will determine if the loan is paid out of the operating reserves or you have to do a special. If you're collecting enough dollars into your operating and reserve accounts to satisfy the annual loan payments, you probably don't have to do a special. We have a number of associations that come to me early and we say, okay, if you get your collection of your reserves up to this level, you're going to pay your loan out of the reserves, you don't need to do a special. But if they come to me and they're only collecting like $50,000 for reserves, but their annual loan payments are $150,000, you're going to have to do a special. All right? The bank is looking, where's the money coming from? Do you have a cash flow stream? All right? So that's the difference between an operating reserve loan and a special loan. Is everybody clear on that? Under the special, if a unit owner sells their unit, they're going to have to satisfy that unit's portion of the loan at the time of the sale. Right? The bank doesn't really care. It's a seller's responsibility, but if the seller works out a deal with the buyer of the unit, as long as it's satisfied for that portion of the loan, for that unit, we're okay. The money's going to have to sent to us. All right? Okay. Fees. And fees, we don't charge a commitment fee or anything like that for our loans. What we do is what we call a fee for the loan. And this fee includes our attorney's fees, our fees for the searches, our annual servicing fees. We don't use title companies during the construction period, so you can submit bills for 12 months. So do that. Also, if you have a unit owner that sells their unit, we will re-amortize the loan up to 4 times a year with no charge. So we want to make sure we keep it an equal 1-to-1 ratio on the loan.
Can you explain that in a little more detail?
Sure. Let's say you have a couple units that sold.
All right.
So you want to re-amortize the loan, so they're going to send the dollars in for that special assessment. We're going to reduce the payment, the principal, and we're going to re-amortize it,
Okay.
all right?
Got it.
So we want to make sure we keep it equal, 1-to-1, all right? The other thing with the fees is it's a one-time fee up front. There's no fees during the lifetime of the loan. It's just right up front. That's it. Okay?
Is that a percentage of the loan? How is that? Is that a
Pardon?
percentage of the loan? What is that fee?
No, it's usually, because we work with the attorneys so constantly around, we know the costs.
Okay,
Usually ours is just a flat fee.
okay.
It's one time. So it also may depend the size of the loan. If they're, you know, if you're buying a unit, we have to get an appraisal, so the fee might go up a little bit, so on that. That's for the associations that are buying a unit for their maintenance person.
Oh, I see.
All right. All right. Is there any penalties on a loan? There is no penalties for prepaying the loan. I have a number of associations will do a 7-year loan, but they pay it off in 5 years. They get extra reserve dollars, they go, what do I do with it? So at the end of the year, they'll make a lump sum payment and pay down the loan and tell us to re-amortize it. So in that case, a lot of times they're paid off in 5 years. Or they know they got another project coming up and they want to get this loan cleared first. So they don't have a prepayment penalty. If you went to another bank to refinance it, it's 1% of the unpaid balance we're going to charge you. So, all right.
Frank, how do you know that? How do you know the funds are coming from another bank?
Because we will file a UCC with the state of Illinois. We're in first position on the loans. So if you go apply for a new one, we're going to come up. If another bank sees that, they're going to call us because they have to pay us off. All right. So that will come up. All right. I'm going to talk about this because I go into a lot of board meetings and they ask me, because we're going to be charging them interest. There's a cost of doing business. But they also say, what if we delay the project? How much is it going to cost you? And I always tell them, it says material costs go up every year. If you delay it every year, depends what the inflation rate. The material cost can go up from 3 to 10%. So you have to look at that. The other thing is, you will have repair costs during those delay years. That's another cost. So a lot of times I tell them it's easier to do the loan all at once, get it done today. And I have associations saying, well, we want to spread this over, 3 or 4 years. And I've been on a couple projects, and they did this over 4 years. This is actually a 30-unit complex, building complex. They're going to do the replacement of the roof over 4 years. The problem was I went back after a couple of years. The shingles are different. Even though they're the same manufacturer, the same things, they had different shimmers. Guess what? People see that. It's from a different lot. It's. I don't want to say I told you so, but you look at it and they're telling me this.
That's what we did. We replaced the roof, so we decided to get the loan and do it all in 1 year
Right.
because of equipment costs, material costs going up, and the chance of it being different colors, and
Right.
plus it's a mess.
Are you talking about one building with different parts, or these are separate individual units you're re-roofing?
Separate buildings that have like 5 or 6 units
I
under
see.
each one.
Okay.
So we
Even though the
did-
manufacturer says it's the same, this way it comes from different lots. That's all it is. The other thing that happened on this complex was who wants to be first and who wants to be last. So there's a lot of unit owners that want to be first, but Nobody wants to be last. So that was a lot of heated discussions in there. So, but you know, it's just something you have to think about is when you do this. The cost of doing business is interest, and that, you know, I have to get paid for it. But what you're doing is getting it all done at once. You have minimum disruptions. It's in a single season, single time, instead of disruptions over a 3 or 4 year period. But that's the cost of doing business. So, and we're here to help. We'll figure out a way that we can do these loans. All right.
Is it easier, not easier, but do you look at the amount of money we have in our reserve funds as to whether you'll loan us or how much you'll loan us?
Right. What I don't want you to do is deplete your reserve fund. I'd like you to keep a good, healthy reserves. It's what emergencies happen. You know, the bank looks down on this is we get a heavy snowfall. You're looking at, do I pay my snowplow bill or do I pay the bank loan? The bank doesn't like to be shorted on the loan. So what we do is, I didn't discuss this, but we have a debt service coverage on the loan. Very simple to figure out. So let's say the loan payment for the year is $100,000. It's 15% of that should go into reserves, so $15,000. That's to satisfy any bad debt or people that don't pay, so you have some reserves to pay for the delinquent people. But that debt service coverage of $15,000, you can utilize the money. It's just going to go into your reserves. It's just budgeted. So we're not going to put any restrictions, but you should have some additional dollars going to cover that. The worst thing is to deplete your reserves. We'd like to see some reserves out there. So,
So do you require a reserve being transferred to your bank?
yes. What we don't ask for the operating. We'd like to have them, but if you're with the company you're sending your operating to out of state, or it's with a different bank, we're not going to move it. We would like a reserve account at the bank.
A reserve account.
Right.
You don't ask us to
Depending on the size of the loan too, and how much you have in reserves. So if you only have 25,000 reserves, we're probably going to ask for it all. But if you have a couple million, you know, we'll work with you on that.
Do you like to see a certain amount in the reserves, like 6 months, 3 months? You know, when you say you don't want to see it depleted, is there
Well,
like a guideline?
I don't really have a guideline, but I like to see, you know, at least 6 months a year in your reserves. You're right. The one thing I'm going to look at is your reserve study. Is if you have other projects coming up in the next couple of years during the life of the loan, how are you going to pay for that? How are you going to accumulate reserves? Because I am going to look at that. So if you only have 50,000 in your reserves, but you have 500,000 in projects coming up, how are you going to pay for that? So, you know, there's a lot of factors that go into it. So, all right.
I can almost see that homeowners would prefer getting a loan as to saving up for a project. Because when we save up for a project, they're paying for that project, and then they may move out the year that project's completed. But if it's a loan, there's a possibility they won't be paying all of that improvement.
Correct, if they sell their units.
Yeah,
So, right.
yeah. Okay.
Like I said, if you're looking at a loan 3 years in advance, call me early. It's easy to run the numbers. You know, it's give you an idea. I went through this pretty fast, and I'm not taking 2 hours of your time. But I just want to give you an idea, you know, what a loan is structured and how we do things, and some of the interest rates that are going on today. Interest rates are low. I can't guarantee what they're going to be after the election. Yeah, we look at Janet Yellen, you know, she keeps saying she's the Treasury Secretary, she's going to raise the rates. The next month she says, no, we're not. So, you know, we don't know how to project this.
So can we refinance our loan?
Yes, you can.
We have to look at that.
If you have a high interest rate, I'd say call me up and see what we can do.
I don't know what it is. I'll have to look.
If you did the loan, 5 years ago, you might have a 7% interest rate.
That's 3 years ago.
Okay? We do that. Also, if you have a loan in place and you have another project coming on board, call me. We will combine the loan with the new project. We'll refinance it. A lot of associations will do that.